Yeah, morning traders, and welcome to New Trading Week Ahead. It was obviously a memorable week across markets last week, certainly in terms of the way that we've had to navigate our exposure across such a plethora of tier one data, but also the reaction and the interpretation of the Fed meeting and the way that the market is convinced now that we're going to be getting extensive rate cuts across all DM space going forward. And we saw that in macro markets, and certainly if you have a look at the front end of the Treasury curve, we saw two-year Treasuries dropping 27 basis points on the week. Similar sort of reaction in UK gilts, where rate cuts got brought forward a little bit. We saw two-year gilts down about 30 basis points, and in Germany, slightly less of a move, but we saw two-year bonds down about 19 basis points. We go towards the back end of the curve, 10-year Treasuries were down 31 basis points. An interesting one there, because if you have a look at CPI fixings, which essentially allow traders to bet on individual CPI prints going forward, they sort of believe that we are going to see the Fed getting down to their 2% target by October next year. And of course, in that situation, there really isn't any need for a restricted territory, and you can bring rate cuts forward to bring it down to a more neutral rate. And that means that I think for 2024, one of the big trades everyone's looking at is these bull steepeners playing through, with the curve should steepen, driven by buying coming through in the front end. We saw 10-year real rates dropping out 30 odd basis points last week. We've got 10s at 169 at the moment. And I think that move in real rates was obviously part of the reason why we saw the dollar index down about 1.3%. And across the space, you can see really good gains across high beta FX. Certainly the Norges Bank surprising that 25 basis point hike last week. I think about 3 basis points of hikes were being priced in there. So the NOK having an absolute flyer, as we saw with the South African rand and also the Japanese yen. But we quite like the idea of NOK gaining against the Swedish krona. We saw that bullish outside week reversal playing through off those lows, and we see follow through buying. I think it's something that I want to run with. If you have a look at equity markets, despite John Williams from the New York Fed pushing back and saying there's talk of rate cuts are premature, we did see equity markets having a very strong week. The Russell was up 5.6%. We saw the US 30 closing at all-time highs, nearly 3% higher. We saw the Nasdaq at all-time highs. We saw Goldman Sachs' most short basket, which looks at stocks with the highest short interest, up 11%. So short stocks being closed out in earnest there. And also the ASX 200 coming on the radar. That market rarely comes onto the radar because it's a bit of more of a value market, a slow-moving beast, but it was up 3.4% on the week, one of the best performing weeks of the year, and we're getting about 2% away from all-time highs, so that's something definitely to put on the radar going forward. In terms of vols, not much of a move in the VIX, despite the sort of the blockbuster moves that we've been seeing there. The VIX is trading around 12%. Rates vols pretty much unchanged. Euro dollar 1 month implied is around 6% at the moment. Now, I think if we look at the sort of wash up we've been seeing from central bank action, and we can have a look at the rates market and swaps market, if we have a look at this kind of the race to who's going to be looking to cut first going forward, and this sets us up nicely for this week. I think if you have a look at US swaps pricing, we've now got a 78% chance of a March cut coming through, and by the end of the year we've got about 140 basis points of cuts being priced. So I mean, do you think that's too much? Do you think that's overzealous? Obviously we're going to be very much data dependent, and that rate pricing is going to be thrown around by what we see coming forward. In Australia, we can see now that the rate cuts are being opened up. This is kind of a new development. There's about a 60% chance we get a rate cut by the May meeting. Looking forward up to the sort of the Melbourne Cup in November, there's 2 cuts being priced in by that situation as well. In the UK, we've got an 80% chance of a rate cut by May. It feels a little bit early, but that's where the market is. We've got 4 cuts by the end of the year. In Europe, we're looking for about 60% chance of a March cut. In theory, they may cut before the Fed. They do have an earlier central bank meeting. And we've got about 150 basis points of cuts being priced by December. It's actually Canada, which I think is really interesting there, because the Canadian central bank will be becoming the first central bank in March. We've got a 72% chance of a rate cut coming through there. So do watch those Canadian exposures this week, because we do have a CPI number in Canada on Wednesday. The market's expecting headline to drop to 2.8% and core to 3.3% as well. So that's the rate pricing that we see. And again, that move that we've been seeing in rates and also in real rates, and a weaker US dollar has really capitulated these equity markets. So one of the questions we are asking for the new week is, are we going to see one last hurrah and a continued push higher, or are active managers going to look to just close their books a little bit move into cash a little bit and call it a year. That's something we're going to be watching. Now, in terms of the event risk for the week ahead, tomorrow the Bank of Japan are going to be meeting. I think this is going to be the highlight. We can expect surprises, so obviously watch that yen exposure. But I think markets have sort of pared back a kind of interest that we're going to see a move away from negative interest rate policy at this one. They're not expecting anything in terms of tweaks to the rate setting. They could set us up for a more live meeting in January. Maybe we see some tweaks to YCC once again, but I think expectations have been pared back. But do watch that because we could get a surprise. We do see national Japan CPI towards the back end of the week. Markets looking for 2.8% on headline and core to drop a little bit as well. The UK is going to be well worth watching. We talked about that rates pricing, but midweek we get the UK CPI numbers coming through. Headlines expected to drop 4.3%. That's a drop of about 30 basis points. And then the core number year on year expected to drop 10 basis points, so a little bit of a tweak there to 5.6%. And then we get retail sales numbers coming out on Friday. In the US, we get core PCE on Friday. That's going to be the highlight of the week. The market, given we've seen the CPI and the PPI numbers, expecting no real move zero essentially month on month for headline. That gives you an annualized rate of 2.8%, and then also on core 0.2%, giving you an annualized rate of 3.3%. So again, we'll have to see how that comes through, because that obviously could move those rates pricing. Apart from that, in the US, we're going to be watching housing starts, building permits, existing home sales, consumer confidence numbers, which may or may not move the market there, jobless claims, and then the leading index as well. In Europe, we've got European CPI numbers. Here's a final print, so we're not expecting that one to move the dial too much, but it will remind us that obviously inflation is going in the right direction and moving very fast. I quite like the idea of being short euro against the Aussie, but I think if you have a look at China, we're not really getting too much. The Chinese equity market really can't get a move on. We get China's real prime rate coming through during the week. We're not expecting any change there. And in Australia, we talked about that rates pricing. The RBA minute should just reinforce the idea that we do have a relatively hawkish bank in Australia. But as we see this week, we're coming off a very memorable week. Can we have one last push in risk assets, or will fund managers and active managers look to just move cash and just to rule the bulk and close that book for the year? We'll see.